Do you want to remain poor? Do you never want to get ahead? Do you enjoy giving your money away every time you get paid? Or do you want to start taking the first step towards financial freedom? Do you want to start building healthy financial habits? Do you want to be in control of your money and not have your money in control of you? On this video, I'm going to share with you the top 3 credit mistakes that people make that keep them poor. And this is from my unique perspective and insider information where I have literally reviewed tens of thousands of credit reports over the past 20 years from my time in the banking industry. And the scariest thing about these credit mistakes is that a lot of them are silent killers. Folks don't even have any idea that their wealth and their income is being sabotaged. In the comments below, let me know what you want to learn about how to manage your credit better, or mistakes that you've made and lessons that you've learned. And be sure to stick around for mistake number 2, because I'm gonna share with you a $500,000 mistake that I made with my credit and how it's still costing me to this day. So if you don't wanna be poor, then it's critical that you don't make these mistakes. Let's jump right in. Poor people mistake number 1, the mismanagement of credit cards. Would you ever go to the grocery store and ask the clerk what the financing terms are on a bag of apples? Would you ever go to the customer service desk and ask if the meat from the deli is available for 0% APR? Would you ever ask if the payment terms on a bundle of bananas can be spread out over 60 months? Well, these are kind of outrageous questions, right? Well, this is what credit card debt looks like when you don't pay off your balance every month. You are literally financing your consumer purchases and doing that with an astronomical rate of interest. Here's concern number 1 with not paying off your credit card debt in full every month. In the United States, we just hit over $1 trillion outstanding in credit card debt. It's such an alarming number, and it's just one indicator of how bad Americans are at managing their credit cards. And what that means is that most folks who use credit cards also don't pay off their credit card balances every month. And when you don't pay off your credit card balance every month, you are paying an astronomical rate of interest. And that rate of interest could be hundreds or even thousands of dollars a month, depending on the balance. And if you're paying this much in interest every single month, you are going to remain poor. You have to pay off your credit card balance every month. And you should never pay any interest on credit cards. And you should absolutely never make the minimum payment on credit cards. Another incredible mistake that consumers make is with the credit utilization rate. What that is a math ratio that looks at the total balance you owe divided by your total credit limit. And this ratio should never exceed 30%. For example, if you have a credit card balance of $2,000 and your limit is $10,000, well, what that means is that you have a credit utilization of 20% in that example. The problem is that most Americans think they can and should max out their credit cards. If you max out your credit cards, it is going to destroy your score. And if you don't manage your credit cards correctly, not only will your score drop, but when you need credit in the future, like if you need to apply for an auto loan or a mortgage, you are actually going to get less than favorable financing terms. So how you're using your credit card today is going to affect your financing terms tomorrow and in the future. And concern number 3 is the overall misuse and mismanagement of credit cards as a financial vehicle. Look guys, credit cards at the end of the day are just a tool. And when that tool is used correctly, it can provide powerful benefits like fraud protection, rewards, points, and cash back. And even other benefits like travel and car insurance benefits. But when balances aren't paid off each month, it means that this financial vehicle or this financial tool isn't being used correctly. You wouldn't use a saw to rake up your fall leaves, would you? Well, when you don't manage your credit cards correctly, what it really underscores is improper use of this financial tool. And what it really points to is a lack of financial literacy. Now, here's the thing with financial literacy. Financial literacy isn't taught in our education system anywhere. And I'm talking about elementary, junior high, high school, and it's really not taught even with our higher education school system. I mean, why aren't money skills taught in school if all of us need to use and manage money on a daily basis. In the comments below, please share with me why you think financial literacy isn't taught in our school system. Do you think this is just happenstance, or do you think there's something more going on, like conspiracy? Hey friends, if you are getting any value from this video, please hit that like button. And if financial literacy is something that you want to learn more about, or maybe you want to share what you've learned, I'd like to extend an invitation to you to join our growing community by subscribing. Remember, financial literacy isn't taught in our school system and it's not valued at all. So it is up to us to learn, to grow, and to share together. So please subscribe, please join this community, and please share this video. I want to hear from you. Your voice matters. Let's get back to the video. Poor people mistake number 2, co-signed debt. And this is one mistake that I recently made here in the past 5 years, even though I knew I shouldn't. Let me ask you a question. Would you ever put your neck on the line and your financial livelihood for someone who has a repeated pattern of behavior of not paying their bills on time? Let me ask you a second question. Would you ever put your financial reputation and your credit score on the line for someone that does not have the ability to repay the debt they are borrowing? Because when you co-sign on a loan for someone, this is exactly what you are doing, although you probably aren't thinking about it in those terms. Now, here's my mistake. And guys, this is a mistake that I made about 5 years ago, and it's turned into a financial catastrophe. In my case, my best friend was trying to purchase a property, but he didn't qualify for the mortgage on his own. And he pleaded and begged and begged and pleaded with me to co-sign. And after about 50 pleas, I finally agreed to co-sign. But in the back of my mind, I knew it was a bad idea. Well, guess what? What a mistake it was. I ended up losing my best friend in the process, and now 5 years later, we don't even talk to this day. And now I'm also on the hook for a $500,000 mortgage, which is still on my credit and I'm legally obligated to pay. Now, the reason that co-signed debt is so difficult to say no to is because a lot of times it's a friend or a family member and they know how to pull on the strings of your heart. Now, the reason that co-signed debt is so dangerous is because number 1, it's a great way to lose a friend or become estranged from a family member because, like my situation, these situations almost never work out. And number 2, from a credit perspective, you are now responsible for this debt. Legally. It is going to report on your credit report, and if the payment gets missed or if the payment is late, your credit is going to suffer. Now think about this. If you are trying to get financing in the future, if you are trying to buy your own home at some point in the future or need to finance something else, well, this is going to be included on your credit and it's going to have to be included in your overall debt profile. So if you have someone else's debt on your credit, it's going to make it more difficult to qualify for whatever you're trying to qualify for, whether it's a personal loan, a vehicle, or even a mortgage. Now, the one exception that I have to this is a parent to child or child to parent or a family partnership situation. As long as everyone knows the risks, then this is the one exception that I support. Here's my take. Co-signing at the end of the day is just not worth it. Don't let my mistake be your mistake. My mistake is still costing me years and years and years later, and I still have $500,000 in my name and I lost a friend. So please learn from my mistake. Poor people mistake number 3 is student loans. Now here's the deal on student loans. Student loans is one of the few types of debt that has the ability to be good debt, bad debt, great debt, or toxic debt. The reason that I have student loans on here is because the student loan characteristic, the repayment terms, are extremely toxic. And if this type of debt isn't managed correctly, well, it has the possibility to go nuclear on the individual. And a lot of times these students, these young folks, they have no idea how student loan terms work and what the repayment terms actually are. Now, first, here are the positives with student loan. Now, let me be clear. Student loans can be good debt or even great debt if they allow you to gain education and improve your skills, which then allows you to build a career and earn more. I have met with a lot of folks and seen a lot of examples where student loans are used in a positive, productive way with an outrageous benefit. And the facts are the facts. College graduates still, on average, earn more annually and over the course of their lifetime than non-college graduates. Here are my concerns, though, with student loans. Concern number one is that the cost of education continues to increase at a very rapid rate. Over the past 10, 15, 20 years, the cost of education has continued to skyrocket and has continued to outpace wage growth. So what that means is these degrees are becoming more costly and with less of a benefit. Concern number two, nearly all other forms of debt out there require the individual to document and demonstrate the ability to repay. When you apply for a mortgage or an auto loan, a personal loan, or other types of debt, maybe like a line of credit or even a HELOC, the lender is more than likely going to pull your credit, review and verify your income, look at your assets, and actually confirm that you have the ability to repay the debt you are trying to borrow and that you can actually afford the monthly payment. With student loans, though, you don't actually have to demonstrate the ability to repay, meaning that a student can take out tens or even hundreds of thousands of dollars in student loans, knowing at the present time they actually have no way of repaying any of it back. It's all based on their actions and their income in the future, which is a scary thought. Student loan concern number three is called the income-based repayment feature, where if you can't afford to pay all of the interest in any one month, they allow you to tack the interest back onto the principal loan balance of the student loan. And what happens is it turns into a negative reverse compounding amortization loan where the balance goes up and up and up instead of going down. And finally, student loan concern number four, once you take out the debt on student loans, the only way to get rid of it is to pay it off or die. Literally, those are the only two options you have. With other types of debt, like a mortgage or an auto loan, you can actually sell or refinance or trade or exchange the underlying asset. And you can use these methods to pay off the debt, especially for assets that go up in value. With student loans, though, you are the underlying asset. And there is literally no way to get rid of your student loan debt other than paying it off. Student loans aren't eligible for bankruptcy and they cannot go into foreclosure. And I've seen example after example after example just seems to hang around for an individual's entire lifetime. If you're considering student loans, consider what the costs are, consider what the benefit of your financial degree is going to be, and make an informed financial decision. And don't let this mistake happen to you, please. Well, thank you for joining, and until next time.